Hi everyone, welcome back to our channel. Today we will discuss about what is BEPS compliance. Before starting this discussion, please subscribe to our channel so that you will receive a notification whenever we upload a new video. And if you like the video, then press the like button. Let's get started. First of all, let us understand what is BEPS. BEPS stands for Base Erosion and Profit Shifting. It refers to the strategies and actions taken by multinational companies to move their profits from countries with higher tax rates to countries with lower tax rates. They often exploit gaps and mismatches in international tax rules to accomplish this. For instance, a company might shift profits to a subsidiary in a low-tax jurisdiction even though the actual economic activity took place in a different country with higher tax rates. Now, you may ask, what is BEPS compliance? So let me tell you, BEPS compliance involves following the regulations designed to stop base erosion and profit shifting by multinational companies. It aims to make sure that profits are taxed where the economic activities that produced them were carried out, rather than in low or zero tax areas. The Organization for Economic Cooperation and Development, OECD, came up with the BEPS Action Plan, which has 15 actions meant to deal with these issues. The plan helps make sure that profits are taxed where business activities happen and value is created. The OECD's BEPS project was started in 2013 because of worries about how international tax rules worked. With more trade and investment around the world, there was a lot of concern about how companies shifted their profits to save on taxes. The project's goal was to update international tax rules to make sure that companies paid their fair share of taxes wherever they did business. As part of the BEPS project, the OECD came up with 15 different ways to stop companies from avoiding taxes. These plans include things like better rules for transfer pricing, stopping tax treaty abuse, and making it harder to hide money offshore. Let's discuss the key elements of BEPS compliance. First one, transfer pricing documentation. Action 13 of the BEPS plan says that big companies must keep good records of their transfer pricing. This means that multinational enterprises, MNEs, need to show how they set prices when they sell goods or services to other companies within the same group. These rules say that transfer pricing practices must be clear and backed by solid evidence. Also, MNEs must give their tax authorities a report called the Country-by-Country Report, CBCR. This report gives an overview of the company's taxes and financial situation in every country where it does business. In addition, MNEs must keep detailed records about how they set prices, both at the company level, which is called the master file, and at the local level, which is called the local file. Second, anti-avoidance rules. To stop aggressive tax planning, countries should think about making rules against tax avoidance. This is the second key element of the BEPS compliance program. These rules should focus on stopping people from taking unfair advantage of tax breaks. Third, dispute resolution. The fourth point of the BEPS plan talks about how to solve tax disagreements between countries, which is another important part of tax compliance. It says that countries should try to work out their differences and come to an agreement on how to tax multinational companies fairly. The plan suggests ways to make the process of solving tax problems between countries better. This includes setting time limits for how long disputes can go on, and setting up groups to help resolve conflicts. The plan also suggests ways to make the process of solving tax problems between countries better. This includes setting time limits for how long disputes can go on, and setting up groups to help resolve conflicts. Fourth, hybrid mismatch arrangements. Another important part of BEPS compliance is stopping fake hybrid mismatch situations. Hybrid mismatch situations happen when companies use the differences in how different countries tax the same thing to cut taxes. This is talked about in the second action of BEPS. The OECD wants countries to do two main things to stop this practice. First, countries should think about passing laws that stop companies from using hybrid mismatch situations to avoid paying taxes. Second, countries should work together to make sure that taxes are imposed on hybrid entities and instruments. Fifth, digital economy and value creation. The first action of BEPS talks about how the digital economy and the way information technology works are changing how business is done. This is especially true for companies in the digital world. The changes in the way business is done affect how profits are shared among the different parts of a company, which makes it hard to figure out where profits should be taxed. To fix this problem, the OECD suggests 4 ways to change the current rules on international taxation. Realize that digital companies create value in many different countries. Make it easier for companies to split up their profits based on where they create value instead of where their physical operations are located. Set up new rules for how profits are taxed in the digital economy, and agree on how to share profits between countries where digital companies do business. Sixth, CFC rules. Controlled Foreign Corporation Rules, CFC rules are meant to stop companies from shifting their profits to low-tax countries without actually doing much business there. To stop this kind of tax avoidance, the OECD suggests that countries think about putting CFC rules into their tax laws. If a parent company is in a country with a high tax rate, CFC rules say that it shouldn't have to pay taxes twice on the same money. Instead, the taxes should be paid by the foreign subsidiary in the country with the high tax rate. Seventh, limitation on interest deductions. Since multinational corporations often use debt to move money between their different parts, it is important to put limits on how much interest can be deducted from taxes. By limiting the amount of interest that can be deducted from taxes, countries can stop companies from moving profits from places where they make money to places where they don't. This is the 4th step in the BEPS compliance program. 8th, country-by-country reporting. CBCR. Big multinationals with lots of money need to give information about their taxes and finances in every country they work in. This is done through country-by-country reporting, which is the 8th step in the BEPS compliance process. This lets tax authorities see how much money the company makes and pays in taxes in each country, which helps stop tax dodging. 9th, tax treaty abuse. To stop people from using tax treaties to illegally move money from one country to another, the OECD suggests making some changes to how tax treaties are written. This is part of the 6th step in the process of complying with BEPS rules. They suggest ways to make sure that tax treaties are only used for the purposes they were made for and to stop people from using them to move money or avoid paying taxes. 9th, limitation on interest deductions. In BEPS compliance, it is important to limit the amount of interest that can be deducted from taxes. This is the 4th action, and it helps stop companies from moving profits to low-tax countries by using too much debt. Now let's talk about the steps to take to achieve BEPS compliance. Step 1. Understand the BEPS actions. You need to learn about the 15 BEPS actions and figure out which ones apply to your business, the countries you work in, and how your taxes are set up. Step 2. Maintain proper transfer pricing documentation. Keep good records of your transfer pricing and make sure your prices are set according to the arm's length principle. This means that when you sell goods or services to other companies in your group, the prices should be the same as if you were selling them to someone else. Step 3. Implement a robust tax governance framework. Put in place a strong system for managing taxes to keep an eye on risks and make sure you follow the rules about taxes in each country where you do business. Step 4. Review and adjust business structures. Look over your company's structure and any deals between its different parts to make sure they work with BEPS compliance. You may need to change how your business is set up or how deals are made between the different parts of your company to make sure that you are following the rules. Step 5. Country-specific compliance. Pay attention to how BEPS rules are put into law in each country. As different countries bring BEPS rules into line with OECD standards, you may need to change how you keep records and pay taxes in each country. Step 6. Engage in transparency and reporting. Give the tax authorities in each country where you do business the right reports, especially the country-by-country report, which tells them how much money you make and pay in taxes in each country. Step 7. Train your staff. Make sure your employees know about BEPS and how it affects your company. This is especially important for people who work in tax, compliance, and reporting. Training will help your staff do their jobs better and will help your company keep following the rules. Now, let's discuss BEPS compliance reporting. As part of the BEPS compliance program, multinational companies must submit various reports to tax authorities to ensure transparency and adherence to tax regulations. Two primary reports are country-by-country reporting, CBCR. Large multinationals must file a CBCR, which provides detailed financial and tax information on a country-by-country basis. This report helps tax authorities track the global operations and profits of multinational companies, ensuring that taxes are paid where economic activities take place. CBCR typically includes information on revenue, profit, taxes paid, and number of employees in each jurisdiction where the company operates. Local transfer pricing documentation. Firms must maintain local files that include documentation related to transfer pricing practices. This ensures that transfer pricing arrangements are in line with the arm's-length principle, meaning that transactions between related parties are priced as if they were between independent third parties. Now, let's discuss the challenges of BEPS compliance. Global coordination. BEPS compliance requires multinational companies to coordinate across multiple jurisdictions, each with potentially different interpretations and implementation of BEPS rules. This can lead to complexity and inconsistencies in how BEPS is applied, making it challenging for companies to ensure full compliance. Increased complexity. Adhering to BEPS standards can increase the complexity of tax reporting and administrative burden, especially for large multinationals with operations in multiple countries. The requirement for detailed documentation, such as the country-by-country report and local transfer pricing files, adds significant complexity to the tax compliance process. Risk of penalties. Failure to comply with BEPS regulations can result in significant penalties, additional taxes, and reputational damage. Tax authorities worldwide are increasingly focused on BEPS compliance, and non-compliance can lead to costly consequences for multinational companies. In conclusion, BEPS compliance is essential for multinational companies to ensure that they are paying their fair share of taxes and avoiding penalties. By understanding the key elements, implementing the necessary steps, and staying informed about changes in tax regulations, companies can mitigate the risk of profit shifting and improve their tax transparency and governance. If you like this video, then please subscribe to our channel and hit the bell icon so that you will never miss out on any future updates from us. Thank you, and have a great day.